let's go right to the question. Simpson-Bowles had top rate of 28%, but it also had dividends, capital gains at ordinary rates in the underlying numbers. So how say you, witnesses, on the question of cap gains and dividends at ordinary rates if rates were at 28%? You think that's a good idea, bad idea, why or why not? Dr. Berman, start with you and we'll go right through the panel.
Well, I actually wrote a book about capital gains, and one of the things that has struck me in my research is that people think of low capital gains tax rates as this big boost to growth, and there are some reasons to think it would encourage certain kinds of investments, but the lower capital gains tax rate is a huge bonanza for tax shelter activities, basically designed to make wages look like capital gains. You have all these people in hedge fund and private equity businesses who are earning their income taxed at a 15% rate rather than at a 35% rate, and there are probably too many people in that line of work just because they're following that tax subsidy. And a lot of the tax shelters that are designed to take advantage of the lower capital gains tax rate are really, really inefficient. The companies doing things for tax, or individuals doing things for tax purposes, would make no sense absent the subsidy. What's more, a lot of the people who are in the business of inventing these tax shelters could actually be doing socially productive work under other circumstances, like maybe trying to invent products, American products that people would want to buy around the world. The Bowles-Simpson proposal, I think, is exactly the right way to go, and this is what Ronald Reagan did in 1986. Get individual income tax rates low enough that you can tax capital gains the same as other income. Eliminate that huge source of distortion. Tax lawyers say that half of the tax code is devoted to policing the boundary between capital gains and ordinary income, and it's actually not all that good at it. You know, obviously there are issues of double taxation, but the income tax is a balancing act. There's no right way to tax capital gains under an income tax. Maybe this is why Dr. Mitchell would say we should just go to a consumption tax. But if we have an income tax, we should tax capital gains the same as other kinds of income.
Dr. Rogers?
I suspect that I largely agree with what Len said, and that's because I come from a bias of thinking that the right basis of taxation is income. So if, you know, when you talk to Dr. Mitchell, he's coming at it from the perspective that consumption is the right basis of taxation, and this is where the disagreement is in terms of the incentive effects of taxing capital gains and dividends like labor income or preferentially. So those who favor consumption basis are going to say that that's not an even treatment because under a consumption base you should have a lower rate of taxation on capital income. I think it's a trade-off, and I think that if you believe in an income tax base as the measure of ability to pay, the standard for taxation, then it makes no sense to tax capital income at a preferential rate to labor income. Distributionally, you get a good result from that. You could think of under an income tax base, capital gains and dividends preferential rates are a tax expenditure, and reducing that tax expenditure by treating all forms of income the same would raise burdens much more on higher income households than lower income households, simply because higher income households get a large fraction of their income from these forms. The question then becomes an empirical one. If you worry about the incentive effects of raising tax rates on capital, you know, you have to weigh that incentive effect and possibly some decrease in private capital formation against the cost of not doing so, which is higher deficits. You know, the benefit you get from raising the tax rate on capital income is that you get more revenue and you reduce the deficit and you raise national saving that way. So that, in my opinion, is a surer way to raise national saving than to keep tax rates on private capital low to hope for more private sector capital formation.
Dr. Mitchell.
In tax reform, the rate is actually the simple part. As you're seeing from our discussion here, it's the definition of income. Do you want sort of the Haig-Simons comprehensive income base, or do you want the Fisher-Turay consumption base? Although I think those terms are misleading because the comprehensive income tax is really a tax on income plus net worth, changes in net worth, And the consumption base is just a tax on income, but with income only being taxed one time, whether you're taxing it once when earned or once when spent with something like a value-added tax. I guess one thing I would add to the discussion, because obviously in terms of just the description, I agree with my colleagues of what these trade-offs are. The one thing I would add is that because of globalization, because the world economy is much more competitive, and because capital is especially mobile across national borders, I think that really underscores how it's very important to keep tax rates low. Now, obviously, if we figured out how to have tax rates at 10%, then whether you had double taxation wouldn't matter, because the overall effective rate, even when you add all the double taxes, wouldn't be that much. So if you can keep tax rates low, double taxation doesn't matter much. You keep tax rates low, loopholes don't matter that much.
Let me ask the panel this question, and I've only got about 2 minutes left, so if you could give succinct answers, I'd appreciate it. In the commission, we had a series of analysts come in, and it was interesting how uniform their recommendations were. They, from whatever philosophical perspective, recommended that we go to a hybrid system, that we have part a tax on income, part a tax on consumption. Their argument was that you would improve the incentives for savings, for investment, and ultimately for economic growth if you did. Obviously, the concern is if you have a hybrid system that you raise more revenue than you otherwise would. But just going to that fundamental question, I'd be interested in the responses of the panel. Dr. Berman?
Well, so that's actually basically the Nordic system that Dr. Mitchell was talking about. There are definitely advantages in terms of economic growth, and it's a more coherent way to provide a lower tax rate on capital. I also have another proposal, which is to a value-added tax that's actually dedicated to paying for health care, and use that as a way to cut individual income tax rates dramatically. I realize that's a bigger reach, but it's actually simpler. We know how to, value-added taxes are used everywhere else in the world, and that would effectively lower the tax rate on capital relative to labor.
Dr. Rogers?
Well, the big reason to go for a hybrid system is because if you went all the way to consumption base, it becomes much more difficult to retain the progressivity in the system. So I think that's the idea, is that you move toward a consumption base in one part of the system in order to improve incentives to save and invest, but you keep some kind of income tax so that you can add progressivity to the system through the income tax.
Dr. Mitchell?
Well, we already, in effect, have a hybrid system today, because we protect, with IRAs and 401ks, we're protecting savings from double taxation. We have the lower rates for dividends and capital gains, which do the same thing. Obviously, I think anything that moves us toward this consumption base will be better for growth.
It's so interesting. I mean, it's really striking how many people, if you just take the politics out, suggest that structure.